We need to talk about oil and how it could impact the entire world, because something about this situation doesn't seem right. Recently, someone placed massive bets against oil prices, just minutes before a positive announcement from Donald Trump. If it happened once, it might be coincidence, but it has happened multiple times since the conflict started. That suggests a pattern. At the same time, there's constant confusion around the Strait of Hormuz. One moment it's open, then it's restricted, then open again. This back and forth creates huge swings in the market. When news came out that the strait was open, oil prices dropped and markets surged. But shortly after, reports showed that ships were being turned back and the route was still effectively closed. This kind of uncertainty creates opportunities, especially for those with early information. Meanwhile, something else unusual is happening globally. Energy infrastructure disruptions are increasing. Pipelines catching fire, unexplained failures, and incidents across multiple regions have been reported since March. Because energy flow is being disrupted, warnings are growing louder. The International Monetary Fund has warned that if this conflict continues, the world could face a serious recession, with rising energy and food prices slowing global growth. Now, some believe the US will be fine because it exports oil, but in reality, it still imports more crude than it exports. The US brings in about 6.3 million barrels per day and exports around 4.1 million. That leaves a net deficit, meaning it still depends on external supply. This confusion about supply is one reason why oil prices appear so inconsistent. Right now, there are effectively two oil prices. The first is the paper price, what you see online. The second is the real physical price, what it actually costs to obtain oil in the real world. The gap between these two has reached around $30 to $40, the largest in history. For example, you might see oil listed at $90 or $100 per barrel. But in reality, buyers are paying $120, $130, or even higher for physical delivery. The paper price is based on futures like Brent crude, but the physical price reflects actual supply and demand. This gap exists because those who need oil immediately are willing to pay much more, while financial markets are still behaving as if supply is stable. In the past, these two prices moved closely together, but now the difference has expanded beyond anything seen before. During the pandemic, oil prices briefly went negative due to a collapse in demand. But this situation is the opposite. This is a supply shock. Peace talks have failed, and the conflict continues. Yet markets are recovering, and there's a narrative that everything is under control. But the underlying data suggests otherwise. The world consumes about 100 million barrels of oil per day. Currently, around 8 to 13 million barrels are missing from supply. That might not sound massive, but it's equivalent to losing roughly half of US daily consumption every single day. Over time, this adds up. Some estimates suggest hundreds of millions of barrels have already been lost during this conflict. Emergency reserves exist, but they are limited. Even when combining spare capacity from multiple countries, it only replaces a fraction of what's missing. Eventually, those reserves will run out, and when that happens, shortages become unavoidable. The effects are already visible globally. Asia has been impacted the most. Deliveries have dropped sharply, with only a small fraction of normal supply getting through. Countries like the Philippines have declared fuel emergencies. Others are reducing consumption or shifting to remote work to conserve energy. In India, fuel distribution has been adjusted to prioritize households. In parts of Africa, fuel is being stretched by mixing it with other substances. Electricity restrictions are also increasing. Australia has started releasing reserves and implementing emergency plans. Europe is focusing on reducing demand to manage the situation. The United States is expected to feel the impact later than others, but its supply buffer is nearly exhausted. Once existing shipments are used up, there will be no cushion left. At that point, the gap between paper prices and real prices will likely close, and that adjustment could be rapid. One explanation for the current disconnect is that large players may be suppressing oil prices in futures markets to prevent panic. But futures contracts eventually expire. When they do, sellers must either deliver oil or close their positions. If supply is tight, this can trigger a rapid price increase, known as a short squeeze. History provides some context. During the 1973 oil crisis, a relatively small disruption caused oil prices to surge and markets to decline sharply. In 1990, a similar disruption caused a temporary downturn before recovery. Today, the scale of disruption is even larger, yet markets remain relatively calm. In previous crises, markets often reacted with a delay. Initial optimism was followed by sharp corrections once the full impact became clear. Currently, there is also a disconnect between financial markets and consumer sentiment. Stock markets are near highs, but consumer confidence is much lower. Historically, this gap does not persist. This issue also extends beyond energy. Oil is critical for transportation, manufacturing, and agriculture. Rising energy costs increase fertilizer prices, which eventually lead to higher food prices. This creates a delayed but significant impact on the global economy. Another important signal comes from bond markets. Borrowing costs are rising in major economies like the US, UK, and Japan. At the same time, China's borrowing costs have declined. This suggests a shift in global capital flows. Higher interest rates increase the cost of debt, especially for heavily indebted economies. When combined with rising inflation, this creates additional pressure. So overall, we are seeing a major supply disruption, a growing gap between real and financial prices, rising global costs, and markets that appear stable on the surface. At some point, these contradictions must resolve. Historically, physical supply realities tend to override financial expectations. Because unlike financial assets, oil cannot be created out of thin air. The key question now is timing. When will the real impact fully reach markets and everyday life? Because once it does, it could affect everything, from fuel prices to food costs. And by the time it becomes obvious, the shift may already be underway.